Dividend ETFs are one of the best investments retirees can make. You need a passive income and limited volatility to navigate your golden years, and these vehicles provide both. Dividend income can supplement Social Security and provide cash flow for you. ETFs also provide a great opportunity to diversify your investments without sacrificing too much risk. To figure out which are the best ETFs for you, it's important to consider where you're investing and what your goals are. Vanguard High Dividend Yield ETF, VYM, offers an easy and effective solution to diversifying your dividend income. This is a very large fund with more than 400 stocks. It invests in mostly large-cap companies, so the risk profile is less risky. The majority of stocks are selected for good dividends with a weighting according to market cap. Passive investments are normally more expensive, but this strategy cuts down on management fees to 0.06%. It's perfect for cost-conscious investors. It's a large fund with about $39 billion of assets under management and over $100 million in daily trading volume. This means that it's highly liquid, which makes it easy to sell without lowering your returns with a high bid-ask spread. Its 2.78% dividend yield may not sound like much, but it surpasses the S&P 500 average and other indices in current market conditions. The Vanguard High Dividend Yield ETF is a low-maintenance option for retirees who want to stick with the basics and don't need to worry about chasing high yields. The ProShares S&P 500 Dividend Aristocrats ETF, NOBL, doesn't hold up to the standards of other funds in its category. It invests in debt securities which are rated below investment grade. This ETF tracks 66 stocks, all of which are S&P 500 constituents that have increased their dividends for 25 straight years. These dividend aristocrats have demonstrated they can sustain long-term growth and profit margins. They are committed to returning cash flows to their shareholders. All stocks are equally weighted in the portfolio to avoid giving too much power to the largest companies and hammering smaller ones unnecessarily. This conservative strategy of looking backward and not forward is resulting in an average yield of 1.92%. Investors have to pay a higher expense ratio of 0.35%. However, this is still a great ETF because it's less risky than other funds and wraps many different types of stocks. The Global X Super Dividend ETF, SDIV, is an excellent choice for investors who are looking for something different. This ETF holds the 100 highest-yielding stocks and fulfills liquidity and financial stability requirements. Not only does it work for large-cap U.S. companies, but it also works for companies in the rest of the world including emerging markets. The resulting allocation is skewed more in favor of international, mid-cap, and small-cap stocks. Furthermore, this methodology drives up the dividend yield without compromising on the quality of your companies. Retirees should consider the higher volatility of this fund, which is inherent in investing in emerging markets and small caps. This could be worth it for retirees who are looking for more return potential. The ETF offers a 7.42% distribution yield right now, which is more than enough to make up for its 0.59% expense ratio. This fund isn't quite so liquid, but most retirees won't have any problems with that. If you're in it for the income over the long term, this should be an excellent choice. This video is focusing on how different types of ETFs can suit everyone's retirement allocation, helping plan for the future with an element of security. Market conditions can change the yield on a distribution, but this is something you can expect to happen. There are dozens of great ETF options for retirees, but 3 deserve a close look from anyone planning for retirement. If you like this video, please do like button. Thank you so much and see you in the next video. Have a great day.